Well, for more on this, the latest developments in the world of oil, Viktor Katona is joining us now, the lead crude analyst at Kpler. So great to have you with us. So much to talk about today, and great to have you on the programme. Pleasure to have you with us. So they just keep on doing this. It wasn't really a surprise, but do you think the extension length was a surprise? Because we're expecting this monthly now, aren't we, from the likes of Saudi and Russia, but a 3-month?
Absolutely. It's really the length that surprised the market, because now they've said that effectively they have a pathway up until December 2023. And whenever something changes, effectively they reserve the right to lower production even further, which is quite the announcement. Effectively, they are saying that their base case is a cohesive, coherent supply discipline whereby they cut production out of the market and they maintain levels which are effectively above $80 per barrel, come what may. And that is a very strong signal. Effectively, the market has understood it. And we have $90 per barrel for ICE Brent for the first time in many, many months. So again, the market understood that this is different than what it used to be before.
And Victor, it's interesting what you just said there, come what may, because we know that that's going to be Russia's strategy for obvious reasons. But when it comes to Saudi, what are they up to here? I mean, they don't need the money.
Well, Saudi effectively needs the money, but it's really the Saudi government that focuses on maintaining maximum revenue. Saudi Aramco is the richest oil company in the world. They make insane profits. But when it comes to funding all the government programs, the NEOM future city of Saudi Arabia, there's a tremendous amount of investment going on in Saudi Arabia. And they have a fiscal break-even level of $80, $81 per barrel. They need high prices so as not to go negative. And effectively, supply discipline that we have seen from Saudi Arabia for the past 2 months is yielding its results. $90 per barrel is ideal for Saudi Arabia. They keep production lower, effectively maintaining reserves even higher than they are, and getting the revenues that they inevitably need. All the other countries within OPEC have pretty much a lower fiscal break-even than Saudi Arabia. So it's really Saudi Arabia driving that effort, reducing production just to maintain the fiscal break-even levels that it really needs.
And for Russia, this is an ideal scenario then?
Ultimately, yes. And what's really interesting about the Russian pledges is that they are not really production cut pledges. The Russians have not cut production up until now. They're just withholding exports from the international market, which also means that they can refine as much as they want. Effectively, I believe that this is going to be the future, really. The Russians are going to send all that crude into their domestic refineries, refine them, and just supply everything that, the surplus that they withhold from the market in the form of oil products. So think of a tremendous amount of diesel going pretty much every single continent.
And just OPEC aside for a second, what about Chinese demand? How concerned should we be there in terms of the oil market?
Well, effectively, the timing of this double announcement of Saudi Arabia and Russia is pretty nicely timed with effectively a bullish sentiment re-emerging when it comes to China. For the first time in many months, we have a manufacturing PMI that's growing. We have a sense that China is buying more, and effectively there's no refinery maintenance in China for the upcoming 2-3 months. So it's going to be a very stable China, not spectacular, but a very solid performance. And Saudi Arabia and Russia, effectively two of the largest suppliers to the Chinese market, will reap the rewards.
OK, super interesting. Thank you so much for coming on the show today here at Reuters. That's Viktor Katona, lead crude analyst at Kpler, for us today.